So I pulled this up. This is the volume on the options at the CME group. This first one is in gold, spot gold, the spot gold contract. So what you can see, it starts at 2018. That's the second half of this year. And we're not even done yet because this only runs through July. So you can see this huge spike in contracts that have been bought in. This is spot gold, and then this is spot silver. Even more extreme, right? So why have we seen nonstop to valuation levels? Because the traders have been piling in here. So don't worry about the volatility, because with all of this piling in, and they've done this a number of times, but the CME has raised its margin requirements, which means that a lot of those contracts were done purely on debt, borrowing to buy those contracts. And if they raise the margin requirements, that means that more you have to come up with, or the traders have to have more cash available, and that is supposed to slow it down. And they did that, and this is what happened in 2000 and actually, what am I talking about? Yeah, 2011, but also back in at the beginning of this trend in 1980. So the CME, kind of like the Federal Reserve, using interest rates to regulate the rate and speed of inflation, the CME is attempting to regulate the rate and speed of those contracts. CME on Friday evening, so this was last Friday evening when we saw spot silver actually go above $80 an ounce. So both spot gold and spot silver making new all-time highs. So on Friday evening, they raised the margin to trade to $25,000 per contract, and that was effective yesterday on Monday. So that's an additional 5,000. So what that also means is that for those entities that are sitting in those contracts and wanted to maintain it, maybe they had to sell some of those contracts off. Wow, wasn't this a good time to take profits? So that's really what's been happening in these markets. Traders are booking profits because they're kind of anticipating that what happened back in 1980, what happened back in 2011 could happen again, which means that because of the requirement, the margin requirement, it pushed the spot contracts into that, remember that cup shape? So pushed the prices down, and then of course they went back up, concluding the cup. Now, it took a while, so is that going to happen again? Are we going to be looking at this long drought? No, we're not, because this time actually happens to be different in that there is a shift that started about a year ago in January with the physical markets taking over for pricing and for price discovery. So this time actually is different because we are transitioning into a new system. What was happening in 1980? There was the kickoff to the pure debt-based system. What was happening in 2011? We were attempting to recover from the great financial crisis. So both of these things, the CME as well as the central banks, were tasked with controlling what the visible price of gold and silver were. Because as you should be able to see by now, a rising gold price is an indication of a failing currency. And with the devaluation trade, all the talk, that's really what we're looking at. But we can dig into this a little bit more, and I want to do that. Spot silver is on track for its best annual performance since 1951. And let me tell you, it isn't even marginally close to its fundamental value. But I want you to look at these extremes. This is as pertains to the gold contracts, and falls 5% yesterday as traders book profit after rally to record. It is the second time the metal has plunged that much this year. Here they are. I'm doing the circle there. and the circle there. So it's easy to do in a paper market, right? Because it's just a contract, quick and easy to buy, quick and easy to sell. Different kind of reaction in the physical metals markets that takes a minute because it's physical. It's not boop, boop, boop. This is real. That, my friends, is not real. But let's take a look at the spot gold contract, and you can see that even better. And remember, we talked about those 200-day moving averages? Even here's those two drops that I just showed you on the previous chart. But even with the yesterday's, and today it's up again, we'll talk more about that in a second. But even with that 5% correction, we're still over 20% away from that red line, that 200-day moving average. And remember, technically, 10% is a lot. It doesn't mean anything, right? It can stay in a range here. It can go back up. Is it going to... What I really want you to understand is we're talking about easy to buy, sell, and manipulate contracts, unlike the physical. But I want to talk about silver as well, because I know that's where everybody is going anyway. And look at the range. That's what I'm trying to show you. That volatile range just yesterday on spot market. Going back to before 2020, there is nothing like that trading range. So it went up, it went above 80, and then it closed down at 72 and change. And you can see that ginormous range. Let's look at it a little bit more closely in the spot silver chart, because you can see, look at that huge run up in those contracts, right? And then what happened after that? Okay, so it closed at $72.15, which is still 71.6% above that 200-day moving average.
Let me tell you something right off the bat. If you're still treating these wild moves in gold and silver like they're some kind of normal market behavior, you're already behind the curve. This is not normal. This is not trader exuberance. This is not speculative froth. This, what we are watching right now, is the visible surface of a monetary system entering its terminal phase. And if you don't understand how these volatility spikes, these margin hikes, these options blowouts, and these sudden air pockets tie into the global reset that has already begun, then sit tight. Because by the time I'm done today, you won't just see the pattern. You'll feel the urgency that's been pounding beneath the market for over a year now. Let's begin right here. These violent swings aren't the story. They're the distraction. They are the symptom of something much, much bigger. Physical demand overtaking paper control. And I don't say that lightly. You've watched me for years. I've covered every COMEX trick in the book, every coordinated sell program, every waterfall decline. And every time you heard me say, paper controls the spot price. Until it doesn't. Well, guess what? We finally hit the until it doesn't. This is the first time in my entire career, ever, that physical markets are asserting price discovery over the paper markets. And we can prove it. Because for the first time since the 1970s, these two worlds are completely disconnected. Look at the CME spot contracts. Look at those charts that nobody at CNBC wants to talk about. Spot gold options volume hasn't just risen, it's gone vertical. Not higher, vertical. The line doesn't slope. It doesn't arc. It goes straight up like a missile launch. The same thing in silver, only worse. If you wonder why we saw silver hit $80 before the takedown, it's because leverage traders loaded up on options like we've never seen before. When you see volume levels that exceed 2008 and 2011 combined, you are not watching a market. You are watching a transition. But here's the part that should scare people who don't own physical. Most of the leverage is debt-based. These traders aren't buying options with cash. They're buying them with borrowing. The margin requirement hike, and the CME timed it perfectly, late on a Friday night, forced anyone holding those positions to cough up another $5,000 per contract. That is a massive financial shock when prices are already elevated and volatility is off the charts. So what happens? The margin call cascade. They liquidate to meet requirements, they dump contracts, and the price drops. And everyone who's still living in Fantasyland says, "See, the bubble popped." No. All you're watching is the paper side of the market get choked back. Because behind the scenes, physical demand didn't budge 1 inch. In fact, it accelerated. Let me repeat that. Paper sold off, physical did not. And this is where the mainstream narrative completely falls apart. In 1980 and 2011, it was the paper system that set price. But in 2024, going into 2025, the physical system is overwhelming the paper structure. That's why spot volatility looks like a heart attack, but physical premiums stay high. That's why the COMEX gets flooded with delivery demands. That's why we're seeing back-to-back-to-back backwardations, something that is not supposed to happen in a properly functioning futures market. Backwardation is when spot trades above futures. Backwardation is when people are willing to pay more for metal right now than for metal delivered in the future. Backwardation is what happens in a shortage. Even more importantly, backwardation is what happens in a confidence crisis. Because ask yourself, why would anyone refuse to accept a cheaper futures contract in the future and instead pay more today? Simple, because they do not believe the future metal will be delivered. I want that to sink in. These aren't speculators betting on price. These are industrial users and sovereign buyers who do not trust the system to deliver. And those industrial users aren't stupid. China's new export licensing requirements begin this week. Not a silver export ban. No, Beijing is far smarter than that. It's a choke point, a gatekeeping mechanism, a pressure valve they control. They know that if they said, "We're banning silver exports," it would spark global panic. So they quietly tighten the licensing, require documentation, reduce qualifying refiners, and slow the stream to a drip. They are consolidating domestic control of silver stocks at the same time the West is draining theirs into industrial consumption, ETFS, and delivery requests. China is doing the same thing they did with rare earths, the same thing they did with palladium, the same thing they did with copper, the same thing they did with gold, but silently. Let me say something that I will stand behind. China has far more gold than the 3,000 tons they claim. You don't run thousands of tons through Shanghai over 15 years and magically wind up with the same 1,000 to 2,000 tons you claimed at the start. You don't run the world's largest refining network and be the second largest producer of silver and end up with tiny official reserves. The math says otherwise. The trade flows say otherwise. The premium behavior says otherwise. And the new licensing regime says otherwise. As for the West, we have margin hikes and press releases. China has metal. And let's talk about those COMEX deliveries. People don't understand how big these numbers truly are. In just 3 days of January, COMEX saw 424,900 ounces of gold and 18 million ounces of silver come into the system, brought in by entities willing to deliver, not withdraw. That is staggering, because in all of December, the total gold delivery was 3.7 million ounces. Yet in the first 72 hours of January, you're telling me 424,900 ounces walked in. That is not retail. That is not hedge funds. That is not small fish. That is sovereigns, institutions, and insiders. And here's where it gets even more urgent. The banks aren't arbitraging each other anymore. They're cannibalizing each other. For decades, Wall Street and European banks operated like a cartel. Deutsche would send metal to JPM. JPM would send metal to HSBC. HSBC would send metal to Scotia. Scotia to Barclays. Barclays back to UBS. Everyone kept everyone else liquid enough to maintain the illusion of supply. It was an equilibrium, an illusion of abundance. But that illusion is dead now. When Deutsche Bank is forced to hand over metal to JPM and Citibank, not paper, not promises, but physical ounces, that is the most important signal we have seen since Basel III. For the first time ever, the smartest, most connected institutions in the precious metals ecosystem want the metal itself, not the promise of metal later. JP Morgan explicitly said the metal was for the house account. Citibank said it was for a client. Who is Citibank's client that wants that much metal? Right now? During the biggest price spike in 40 years? Let me ask you something. If a client is taking delivery in the middle of this insanity, do you think they're trying to trade? Or do you think they're preparing for something? The reason I'm pressing this so hard is because people still cling to the idea that a margin hike means the bubble is bursting. No. Margin hikes do not burst bubbles. Margin hikes reveal which side is over-leveraged. And right now, the over-leveraged side is not the buyers of physical. It is the shorts, the entities that for 40 years have sold silver they did not have, confident that no one would ever call their bluff.